So hopefully, we find a way through this uncertainty and the fog here, in the not too distant future. When I say that, I mean weeks, maybe few months, but not much more than that. Otherwise, we probably will land in a recession.
Hi, everyone. I'm Gunjan Banerji.
And I'm Telis Dimos. And this is WSJ's Take On the Week, the weekly show where we give you a leg up on the worlds of money and investing.
Today, I'm so excited about this conversation we had with Mark Zandi, chief economist at Moody's Analytics. And with all this talk of a recession out there, Telis, he was talking about how he thinks the U.S. economy can withstand these higher tariffs.
Well, that's obviously an essential conversation. But related to tariffs, I got to tell you, there's something I'm obsessed with this week.
What is it?
It is rare earth magnets.
Huh.
Turns out rare earth magnets are the linchpin of our trade dealings with China right now. The Journal has been all over this story lately. Basically, rare earth magnets are essential for producing things, particularly cars.
And China produces a lot of them, right?
Right. Well, you're stepping on my punchline there, Gunjan. Yes. So they are essential for like electric vehicles. That's what allows them to operate at high speeds. They're also used even in like windshield wipers and the headlights on your car. And they come from China. And the U.S. needs them to keep coming from China. When China and the U.S. kind of struck their sort of initial pause, part of the agreement was that China would license some U.S. companies to keep importing rare earth metals. The Trump administration has said that China isn't really doing that, and it's causing really huge problems for automakers. The Journal had a story saying that car production in the U.S. might halt within weeks if we don't get the rare earth metals flowing again.
That's crazy. Might halt.
Yeah, and I just want to emphasize how topsy-turvy this sort of could, in theory, be, which is that obviously part of the point of tariffs is to reshore production of things that we used to import and now make them here in the United States again and bring back manufacturing jobs and things like that. But this is a case where what U.S. automakers are worried about, according to the Journal's reporting, is that if they can't get their hands on rare earth magnets, and we're talking about things like dysprosium and terbium, that if they can't get their hands on those things here, they might actually have to make more things in China and then bring them to the U.S. To finish the car. And so we might actually see offshoring of certain things that are currently produced here today. And it just shows you how tricky these trade fights can be. Now, it does sound like this past week that when President Trump and President Xi spoke on the phone that they talked about this issue, rare earth magnets. So perhaps this will be resolved. This is just, of course, one of many kind of like debating and discussion points.
In addition to tariffs, the number one thing I keep hearing about from investors is this deficit, this tax and spending plan in Congress. Elon Musk recently called the bill a disgusting abomination, not mincing words there.
Yeah, little breakup there between Elon Musk and President Trump, who had previously been working closely together on Doge government cuts.
And Jamie Dimon warned about a crack in the bond market. So it feels like even though the stock market has kind of been brushing off the tariffs, right, the taco trade, Trump always chickens out, has been the hottest trade recently, where the stock market isn't reacting as much to what's going on with daily news on tariffs. We've seen some big swings in the bond market because of the potential for rising deficits in Washington. This tax and spending bill is poised to raise our deficits by trillions of dollars, and that's shown up in the moves in the bond market.
I think one thing that the Trump administration believes is that tariff revenue can help offset some of the tax cuts that they're doing and should bring the budget into more balance. But with such uncertainty about what tariffs are and what those revenues might be, I don't think that Wall Street is taking all that seriously, the idea that there's going to be a major offset coming from tariffs. And the trade deals, right, which are meant to sort of lower tariffs and get us other benefits, like those reduce those revenues, right? So it's like good news for tariffs from the market's point of view is bad news for deficits.
And all of that impacts bond yields and what treasuries are doing. And that has a ripple effect into basically every financial asset on the planet, right? From stocks to other types of bonds to mortgage prices and rates on car loans.
Yeah, I want to call out in particular what's going on at the long end of the bond market. And by that, I mean the longest duration bonds. And that's like 30-year bonds.
That's where all the action has been recently.
Right. That's where all the action has been. So most people don't buy 30-year bonds.
Sure.
not that many investors really buy 30-year bonds. Why do you think the market is so keyed in on that? Because, when most people think about treasuries in their portfolio, they think of like maybe 10 years.
Sure.
Usually they're even talking about shorter term, right?
Yep, those are the benchmarks.
Short-term bills and things like that. Why do 30 years matter, do you think?
It's interesting because I think the 30-year Treasury yield, which has been rising toward 5%, that's kind of the danger zone that a lot of investors are thinking about. That's reflecting concerns about longer-term deficits and longer-term economic growth in the U.S.
Yeah. I did want to call out that like on the budget, I think what has sort of really kept that on the radar are, we're starting to get some of the estimates of the cost of the current budget package. The Congressional Budget Office, the CBO, came out with $2.4 trillion as the cost, right, as the increase the deficit over time. I think that number may move around, but I just think getting something of that size as a starting point has really alarmed. I mean, look, at any point in the last 20, 30, 40 years, people, have been warning us about, budgets and deficits and things like that. But it just seems like between the trade, between trade stuff and tariffs and concerns about what that means for the U.S. dollar and sort of demand in the U.S. We talked about in a prior episode the U.S. exceptionalism trade, whether or not people just want to own U.S. assets, that's basically gotten way sort of out of whack. And so now people are going to be rebalancing. All those things have really, I think, just brought that deficit conversation back into the mainstream, where before it had been something that was like, oh, okay, there are a couple of like, sort of Cassandras in Washington who talk about it.
Sure.
Now it's like you said, Jamie Dimon is sort of bringing it center stage.
Individual investors I've been chatting with are bringing up the deficit. It's not just a topic reserved for bond traders right now.
Those really high long-term yields do have implications for the stock market, I think, because some of the investors that do buy those things are like insurers, pension funds. And when those yields are so high, right, they might kind of rebalance more into fixed income and out of stocks, right? Because if you're getting, 5+% to just sort of lock up your money, maybe you don't want to take the risks of stocks. And so the same worries about the U.S. economy that play out in the stock market kind of fuel the bond market. And I think it's something that we're going to, really keep talking about on this show. Wink, wink, future episodes just for people who want to keep tuning in.
And we could see more volatility there with CPI coming up and this big inflation report happening in just a few days.
This report, just like we've started to see some tariff stuff really come through in other economic data like, import and export levels, some of the jobs data has started to reflect that. I think that this CPI might be, because, as we've talked about on the show, Walmart has said that it can't really stop not raising prices. The New York Fed did a survey that it released this past week showing that like a lot of manufacturers in its region are passing through tariff costs to consumers.
They have to.
And so, so I do wonder if these are the reports that are going to start to play out. Though the expectation currently, economists forecast, according to FactSet, that the April pace is going to continue in May. So currently nothing really flagged there, but I do think it's going to be worth a very close watch.
So Mark Zandi, chief economist at Moody's Analytics, had some really interesting thoughts about how our feelings about inflation and the economy can impact the economy itself. That's after the break. You oversee this incredibly granular data as chief economist at Moody's. You've been following the economy for 35 years, and yet you recently said that you've never felt quite this unsure about where the economy is headed.
Yeah, 35 years, that's a long time to be doing anything.
It is.
And I've seen it from a lot of different angles. I mean, I started my own company with my brother and good friend and best friend, and we sold it to Moody's in 2005, right before the financial crisis.
Oh, wow.
And we've been part of Moody's ever since. So I've seen a lot of business cycles through lots of different business environments. And there's only two other times historically where I've been as unsure about the outlook. The first was in the financial crisis back a generation ago. And that required a very aggressive government policy response to kind of get out of that mess. Remember TARP, the $700 billion Troubled Asset Relief Program, bailout. Yeah, that worked. And then the pandemic, the shutdown, that was, wow. I mean, try to figure what that meant for the economy was, because, obviously a lot depended on the virus, and who knew. We got out of that scrape because, we marshaled our resources, got a vaccine, and that worked. And Also, tremendous support from the government, both from the Federal Reserve and from fiscal policymakers. A lot of support. But here we are, and I'm as unsure as I've been since those two other episodes. But this time it goes to economic policy itself. Uncertainty around everything from trade policy to immigration to reconciliation to the debt limit, all those things. There are a lot of economic policy balls in the air, and it's that uncertainty around those policies and that I think is, the risk here. Weighing on the economy is the reason why I'm so unsure, because I just don't know where policy is headed.
Yeah, it seems impossible to predict right now, which has shown up in the crazy market swings that we've seen the past few weeks.
Well, even though it's impossible, I give it a try. Because that's what I do for a living. But the way to handle that is scenarios, right? You got to think about the world. It's not just one possible outcome. There's multiple possible outcomes. And if you're a business person, an investor, a consumer, policymaker, you need to think about, what is the appropriate way for me to respond, depending on which path we go down here. I think that's the lesson from all this uncertainty. I'm unsure of what actually is going to transpire, but I am very sure that we should be thinking about lots of different scenarios as we move forward.
So it's interesting because I think a lot of investors have been focused on kind of this divergence between the soft data, which shows that people are feeling really terrible about the economy right now, and then the hard data, which has held up. One thing I've been really curious about in terms of the soft data is that whenever this consumer sentiment data comes out, there's always this really big gap between how Republicans view the economy right now and how Democrats view the economy right now. And it seems like things have just gotten more and more polarized the past few years. Does that change your weighting to the sentiment data or how you look at that?
Absolutely. I think everyone is now looking at their world, including their economic world, their finances, through the kind of their own political prism. And you see that vividly in the sentiment surveys. I mean, where that's seen the most obvious is in the University of Michigan survey. That's the other major sentiment survey. And, if you go back a year ago, the Democrats were feeling pretty good about things. Republicans thought it was the worst economy since the great global financial crisis, GFC. After the election, with President Trump's re-election, that completely flipped. And now the Republicans are feeling, hey, everything's reasonably okay. They're not feeling great, but they're feeling pretty good. And the Democrats are the ones that think things are as bad as they've ever been. Obviously, neither is true, but that goes to the political dynamics that we're now kind of in the middle of. That's one reason why I like the Conference Board survey. The way the survey is actually conducted, abstracts from some of those political overlays and that affect the University of Michigan survey. And the Conference Board survey, if you look in recent history, it does a much better job of correlating with actual consumer behavior.
So can political polarization impact our economy if it weighs on how people feel about the economy?
Absolutely. Yeah, I think so. I mean, I do think, Democrats are probably more cautious, in their spending and behavior because they are nervous. They say they are, and they are nervous. And conversely, before the election, it was just the opposite. Republicans were probably more cautious, thinking that, things weren't going to go well, and therefore they were not spending as freely as they might otherwise. Same with business people. Business people have the same political biases, and it affects their behavior. So, if you're a business leader and a Democrat, you may be more cautious because you're just more worried about things like the trade war and immigration policy and the reconciliation bill than a Republican would be. So, yeah, I do think this, this polarization is a result of our economy and what's gone on economically, over the last few decades. But it also has an impact on the economy, and that's, I think what we're observing to some degree in the data.
That's fascinating. So there's kind of like a feedback loop going on.
And, that's the other thing about confidence and sentiment. Historically, typically, in a typical economy, confidence, no matter how you measure it, whatever survey you look at, is a reflection of the economy. It's what people feel about their job prospects, how they feel about inflation, how they feel about the stock market or housing values, because that's a key asset. But there are times when the causality shifts and confidence drives behavior, and that's recession. That's when recessions occur. In fact, recessions are, in a sense, a loss of faith, a collective loss of faith. It's not just Democrat or Republican. Everyone kind of loses faith that they're going to be able to hold on to a job, and they
Sure.
go into the bunker and stop spending. That's why it takes 6 months after confidence falls before you get it showing up in recession. And it's also a loss of faith by business people who see consumers pulling back, and then they think, oh, I'm not going to be able to sell what it is I produce, and they start laying off. And then you get into that kind of self-reinforcing vicious cycle. That's a recession. It's a psychological phenomenon. We all collectively decide, oh, we got a problem where we're going to run for the bunker and stop spending. And that's when you get recessions.
So do you think we'll see that this year?
I'm hopeful not. I think not. But it really goes back to where we started the conversation. It depends on policy. It really does depend on how these policies, economic policies, play out. Now, I do think, fortunately, that the administration president is willing and able to pivot when things doesn't appear like they're going well. So if the stock market is
They
down,
already have a little bit, right? We've seen this 90-day pause on tariffs.
Exactly. So if, they're taking that all. It feels like policymakers are taking it all in, and when things feel like they're not going down the right path, they pivot. And I'm hopeful that will continue. And if that's the case, then I think we'll be able to avoid recession. Because at the end of the day, the reason why the economy is struggling, why we're even talking about recession, is economic policy, the uncertainty around that. And if you take that away, if you resolve some of these things and provide some clarity, then presumably the economy can find its footing. Now, that you can't do that forever. At some point, people are going to lose faith, and they are going to pull back, and we're going to go into recession. And it's very, very close. So hopefully, we find a way through this uncertainty and the fog here, in the not too distant future. When I say that, I mean weeks, maybe few months, but not much more than that. Otherwise, we probably will land in a recession.
During the pandemic, March 2020, obviously we did go into a very short recession, but we bounced back in record time. Turns out the U.S. economy was just so much more resilient than many investors, economists, analysts I was chatting with at the time anticipated. 2022, I think you correctly at the time called that we would not go into a recession because of the Federal Reserve's interest rate hikes. Though at the time, a lot of people, again, we thought the Fed's rate hikes would tip the U.S. into a recession. That recession did not materialize. And now you're saying that we can withstand these higher tariffs, right? What is it about the U.S. economy that makes us so resilient?
We've got a lot going for us. I do think, we do lead the world and have led the world in terms of innovation and technological change. And that drives productivity gains, and that's kind of the magic elixir that drives, broader economic growth and the improvement in our living standards. And we are in a very fortunate period where technology is advancing very rapidly. I mean, obviously, artificial intelligence kind of leading the way. But there's other things going on as well that are, I think, really critical to underlying economic productivity growth and economic growth, and that continues. That continues. Now, we shouldn't take it for granted that it will continue. We need to make sure that the best and the brightest come here to get educated and stay here and become the leaders of these companies like they are. And we do need to think about immigration policy. I mean, I do think immigration is critical. Securing the southern border is absolutely necessary, but we do need immigrants of all skills, low-skilled, middle-skilled, high-skilled, to drive growth. And that historically has been part of the secret sauce of the American economy. So if we don't lose that, if we maintain that, and we continue on with our prowess with regard to technology, I think that allows us to get through lots of scrapes, lots of things like the pandemic or whatever it is.
Sure.
We'll be able to make our way through.
So don't bet against American exceptionalism just yet, as a lot of investors have this year.
I'm not sure we're exceptional as we thought we were, back a year or two ago. So I wouldn't overstate that case, but I do think the American economy is an amazing system, and we've got a lot going for us, and we got to make sure that we don't undermine those comparative advantages. But as long as we don't, I think we should be okay.
It sounds like you're saying you do think the economy is in a more fragile place. What are you watching that would tell us that we're kind of hitting a danger point? with the economy. I always hear that the jobs rate can stay pretty steady, but once things start to turn around, it can be hard to stop that in terms of unemployment or other indicators. What are you watching there?
Yeah, I think right now it's about layoffs. I mean, the job market has weakened. We're seeing less hiring. Businesses have cut hours back for workers. So the job market is on the soft side, but the economy, there's just, so far at least, there hasn't been significant increase in layoffs. And as long as that continues, I think consumers will hang tough and will continue to go forward without an economic downturn. The best barometer of layoffs real time is unemployment insurance claims, initial claims for unemployment insurance. And I'll just give you some numbers to make that concrete. It comes out every week, Thursday morning, Bureau of Labor Statistics. Right now, the weekly claims are running 225, 230,000 a week. That's fine, no problem. They've been edging a little higher, and if they go over 250 a week, then I'd send off a yellow flare or two. If we get to 275, I'd be sending off a lot of yellow flares. If we hit 300, I'd send off a red flare. That means that businesses have lost faith. They are uncomfortable that they're not going to be able to sell what they produce, and they start laying off. And you get into that self-reinforcing vicious cycle where the layoffs cause consumers to pack it in and pull back on spending, and you get into that kind of that negative flywheel. So we're not there. And fortunately, UI claims are still low, but I'd watch that, very, very carefully. I think if we're going into recession, that's where you'll see it happen.
I want to pivot to inflation a little bit. We have some inflation data coming up. The Fed, in their recent minutes, indicated that they're worried about a stagflation scenario. How do you expect these tariffs to shape prices in coming months?
Yeah, well, it's directionally stagflation. Tariffs, they raise, by definition, it results in higher prices, right? Tariff gets translated through to consumers in the form of higher prices, and so inflation, and it weakens growth because with the tariffs, the higher prices, it's kind of like an effective tax. You have to pay more to buy the same stuff, therefore you can buy less stuff because you're paying more for it because of the tariff. So that's weaker economic growth, and that's higher inflation. That has the flavor of stagflation. So the tariffs and the trade war put the Fed in a tough position, but I think at the end of the day, push comes to shove, they'll be very aggressive in raising rates to ensure that we don't go down that stagflation path or go back to anything close to what we experienced in the 70s and 80s. The one thing I will throw in, though, that is important to consider and makes this a more serious possibility is immigration policy, right? Because that also it results in kind of stagflation impacts. It weakens growth because you have fewer people here working, and it raises inflation because it tightens up labor markets and causes wages to rise more significantly. In fact, in some key industries, immigrant labor is absolutely critical. Like in the construction trades, over a third of the workforce is immigrant, and about half of those are undocumented immigrants. And that's nationwide. So if you go into the southern, western parts of the country, if in some markets over half the workforce is immigrant. And so if those workers aren't there, it's just going to be harder to build homes. And, that means higher prices, higher rents, less affordability, higher housing costs. So it's not only the tariffs and trade war that have lead to stagflationary kinds of dynamics, but same with the immigration policy if we're not careful.
So I thought Campbell had some really interesting comments in its earnings results. So they say consumers are cooking at home at the highest levels since early 2020 and turning to our brands for value, quality, and convenience. And, that's just one comment, but highest since 2020. I mean, that made me wonder, are people trading down in terms of the types of food that they eat? Are they eating out less because of inflation? Are people just feeling this in their pocketbooks more right now? And maybe that's not showing up in some of the other data quite yet.
Yeah, no, that's a good point. It's not only the signs of weakness. You go back to the hard data. The signs of weakness are not only in the slower rates of growth in spending, but it's also it's represented or reflected in a shift in what consumers are spending their money on.
So with all this talk of a recession out there, What do you think is the biggest reason to be bullish on the U.S. economy right now?
Biggest reason to be bullish, again, it goes back to the fundamentals. I mean, I think the fundamentals, are good. It's just the uncertainty around economic policy that's, creating the issues. So if we can get some clarity around those policies and kind of get to the other side of, the tariffs and the trade war and the reconciliation bill and the Treasury debt limit. And by the way, those are all in train, and they all will need to be resolved here in the next few months. If we can get to the other side of that, I think the resiliently strong economy, the fundamentally strong economy will start to shine through again.
I have one last question for you, Mark. But before that, we're going to take one quick break. So I think all this talk of a recession this year has put people on watch for recession indicators everywhere. Some people have been watching for women and their hair color. Are they skipping the hair appointments? Apparently, the return of professional workwear can be kind of a recession indicator. What's the most unusual recession indicator that you follow?
One kind of really in the weeds esoteric indicator I look at is the number of job openings in manufacturing. Because manufacturing is kind of on the front lines of everything that's going on, the tariffs, the trade war. It's also, even in most business cycles, it's the first sector of the economy to struggle because it tends to be very interest rate sensitive, and higher interest rates are often the cause of recession. So when you see when manufacturers start pulling back on their open job positions, it tends to lead recessions by 6-12 months. And I don't want to overstate the case because, like most indicators, we don't have a long time series, so not a lot of data points. But the data points we do have suggest that that's a pretty good indicator to watch. And I think particularly in the current context, because I do think manufacturers, that's where you'd expect the trade war to do some damage here pretty quickly.
Mark, this has been awesome. Thank you so much for joining us today.
Yeah, anytime. I appreciate the opportunity, and hopefully I'm at least half right about things. Campbell's Soup, the
Campbell
consumer
like
products
the
company?
soup.
Okay.
Yes.
Because they're very close to me. They're here in Camden. I know them well.
Oh, okay.
They're
Okay, so
headquartered
you'll
across
be
the
the
river.
expert on this.
I love tomato soup. I love their tomato soup.